So the week kicked off with the Greek government coming out saying that they're not looking to restructure the debt provided by the IMF and the ECB. This caused a bit of a worry in the market. Greek bond yields on the 2-year and the 10-year, specifically the 10-year, if you have a look at the chart, they gapped out to 14.5%, which is double where they were in May last year. It's been quite a turbulent ride this year on the Greek bond yield. On top of that, there's been further concerns in Ireland and Spain, which have current yields of about 9.9%. So they're not far away from the turmoil that the Greek bonds are seeing. If we look at the CDS spreads, which is essentially a measure of how likely a country is essentially to default, or a company for that matter, this is basically a sovereign CDS spread. This measures whether the market believes that the country is going to default. At the moment, the CDS spread, as you can see from the chart, has been continually rallying with a bit of turbulence since May of last year. It's now up to about 1,250 basis points. That indicates about a 65% chance of default. That's how the market's viewing it at the moment. The other main event from the beginning of the week and the end of last week was China coming out with their GDP figures. CPI figures. So basically, the CPI figures came out above the 5% mark for the first time since 2008. They came out at 5.4%, which was ahead of the expectations of 5.2%. And on top of that, the growth for the first quarter came out at 9.7% against the expected growth of 9.4%. So this is putting further pressure on the China central bank to raise rates over there and increase the reserve requirement. By far the largest event of the week was the S&P Standard & Poor's coming out and putting the US on rating watch negative. This happened on Tuesday, just before the US session kicked off at about 2 o'clock. At that point, we saw probably a 30-35 point drop in the FTSE. And we saw subsequent drops across the pond. This led to a dramatic weakening in the short term of the US 10-year future. If you have a look at the chart, it was trading around about the 120.08 level, and it dipped off to 119.16. So quite a dramatic fall there. It was quickly recouped. By the end of the day, it was trading back at the same range that it had subsequently been. This also caused a knock-on effect to equity markets both sides of the pond. The FTSE, as I say, fell about 35 points, but any losses there were quickly recouped. If we just move on to the other kind of main events of the week on the economic side, further concerns about inflation, as well as continuing concerns in the Middle Eastern region and sovereign risks, have pushed the gold price to an ever-continuing high. We pushed through the $1,500 per ounce mark this week and traded up to $1,505, which is pretty much as it stands at the moment. If you have a look at the chart, it's just been a continuing push upwards, really since the beginning of last year, as especially sovereign wealth funds continue to push into this area. Moving across to the stock side of things, the main event, really, the main company to report in the FTSE this week was Tesco, which is currently on the Killik buy list. They had a dividend increase for the first half of 10.6%. It puts it on about 9.8 times 2013 on a P. We continue to be favourable of the company. The new chief exec who's come in there basically initiated 5 key points, a couple of which were to keep UK strong and continue its growth as well. They're looking for international growth, so they continue to expand into new markets. And on top of that, they're continuing to expand into new areas, so for example, the retail banking in the UK. The other main company to report as well was Burberry. It's one that we featured a couple of weeks back in the podcast. I think Paul mentioned it ahead of the trading update. They've just had the results. About 12.5% of their sales accounted for by Japan. Obviously, the tragedies that happened over there. Burberry was one of the worst hit stocks. They traded down from about £12 to roughly £11. The majority of that has been recouped before the results. The results were pretty stellar, ahead of most expectations in the market, and they've since continued on to be above where they were pre the disaster. Just moving on to, sorry, this is just a comparison to the RBS Luxury Goods Index, just to show you how Burberry have outperformed in comparison to other luxury goods in the sector. If we move on to the US, there has basically been around about 23 companies reporting this week, 18 of which have outperformed analyst expectations. So the main features there have been Morgan Stanley, Goldman Sachs, Citigroup, Intel and Wells Fargo, all of which have been above expectations, leading to us having a rather strong day on Wednesday, with the FTSE trading up about 130 points at its peak, and the US equally strong.